We had a fairly strong performance in the S&P last week, although there were some notable companies that were down. Alphabet more than 4%, Amazon nearly 3%, as well as some others. Now, what we are noticing is that the market sentiment has started to turn positive. We're now back into greed. Remember, just last week we were sitting into neutral, where the market was hanging in the balance. Now, this week we're taking a look at 7 undervalued dividend stocks. Each one has room for massive potential. As always, we'll look at each one at a high level. We'll also understand where management believe this company will be over the next 4 quarters. We'll look at their historical forecasting accuracy as well, and then run into some of the metrics, not just the dividend safety, but we'll also take a look at both dividend yield theory, compare their forward P against the 5-year average, and ultimately understand whether or not these are high quality companies. We'll look at the free cash flow over the last 10 years, sales growth, ROIC, debt levels, as well as many other identifying factors. And we'll run each one through our valuation model. We want to understand what is our intrinsic value, what is the margin of safety we see, 10, 15, 20, 30, 40%, and also take a look, are Wall Street bullish? What is the upside they anticipate over the next 12 months? And as we said, each one of these, nice upside as well as a nice margin of safety. Now, earnings season is also starting to come to an end. As we can see, less and less companies are reporting now on a week-on-week basis, but there are some maybe interesting ones that you want to keep an eye on. For example, Dell are reporting after the market close on Tuesday, and as always, we will cover some of the more interesting ones on this channel. Now, for those that want a quick recap of what happened over the market over the last few days before we do get into the in-depth look at these stocks, well, the big one was that Nvidia reported their earnings, and we can see they've nearly doubled their revenue on what they believe is a continuation of the strong AI demand. And well, they delivered, no surprises here, a better than expected forecast for the current quarter, as well as beating both EPS as well as their sales for the quarter that they just announced. Now, taking a brief look at how they actually performed for those that want to see the numbers behind, just in case they missed it. EPS, 81 cents, a lot better than analyst targets of 75. Top line revenue, quite significantly better. We're talking nearly 2 billion, 35.08 versus the 33.1 expected. And we can also see for the current quarter, they believe they'll bring in around 37.5 billion. Again, that is higher than what Wall Street anticipated at 37.08. Now, this ultimately implies, because Q4 will bring an end to their year, that they'll see around 70% growth from the previous year. And some people are getting a little bit worried, as that is a slowdown from 265% of annual growth from the same period before. So just a few things to bear in mind. Again, people may say that is still growth, but a lot of analysts are comparing the 94% growth that we just saw on a year-on-year basis against others that this company has performed very strongly. We're talking 122% from the previous quarter, and going back even further, 262 and 265%. Finally, their bottom line also increased very sharply to 19.3 billion for the quarter against the same quarter's performance last year of 9.24. Question is, as an investor, do you believe that the growth is going to start to slow down? Is it essentially a case now that a lot of the catalyst for the AI revolution has already been baked into the price? Something to consider, but also do go ahead and check out the in-depth dive that we did after the earnings just last week. Now, the second piece of news that was very big was, unfortunately, Alphabet shares did drop around 4 to 5% on the week. We say unfortunately, but ultimately, if you're a longer-term investor and you do believe in this company like we do, then this could be a great opportunity to consider buying the dip. But ultimately, the DOJ, Department of Justice, are pushing for Google to divest their Chrome branch, and we can see this is something now that is becoming to take a lot more shape. Investors are starting to get worried, and as we can see, this is the recommendation following a federal judge ruling in August that Google has held an illegal monopoly in search. Now, similar to Nvidia, this is one we did a deeper dive on last week, but for those that missed it, we are going to cover it today, as we do believe it is a great company to consider for the future. Finally, just a little bit of interesting news here. Bitcoin, whilst as of this recording hasn't yet hit $100,000, it has hit all-time highs just over the last week, and it was sitting around $99,000 as we can see for the first time. We also notice a lot of this bullishness around Bitcoin is that there is a lot of hopes being pinned on Trump's presidency, his term, that effectively they will bring in a lot of good factors for crypto as well as Bitcoin, and we can see Bitcoin itself is up around 130% in 2024. Now let's jump into these stocks. As we said, 7 each one, very nice upside, nice MOS and high quality, as we will digest in today's episode. First thing to point out, Alphabet, we do get that double buy rating from Seeking Alpha on Wall Street. For those that want to know, for a strong buy, this would need to turn to 4.5, and for a buy, this would need to flip. So Quant do believe, or are, as we would say, on the fence, but right now, double buy and a hold. It is trading around the midpoint of the 52-week range. We have a forward P. Now this sits below 21. Not only is it below the S&P that sits around 25, but it is also the cheapest valued Magnificent 7 stock. And they have, although recently introduced a dividend, the forward yield sits around 0.48%. Over the last 12 months, well, up 22%. As we can see, just over the last week, it is down more than 5%. And if you've been a long-term shareholder of Alphabet, you would be up more than 500%. Bear in mind as well, you would have significantly outperformed the S&P 500. Now, when we take a look at forward expectations from management, we can see every quarter they are expecting growth year on year, and on top of that, they have outperformed analyst targets, 100% track record over the last 4 quarters. The more recent one was a very nice beat of 27 cents, and ultimately they do believe the earnings per share will continue to increase over the next 4-year accounts, there in turn lowering the forward P to 18.7. Now, taking a look, firstly, dividend safety score of 80 indicating safety. We'll run through these two models, but right now they haven't as of yet increased the dividend, as they've only just started to pay one. So we'll see information for the others today, but unfortunately for Alphabet, they are just a newly paying dividend company. Now, it was reaffirmed, although really irrelevant given they've just started to pay a dividend. It would be unlikely that they would suddenly cut it, but an 80 safe score for those that want to know means that a dividend cut is unlikely. Now, for each one of these 7 companies, we will look at some key metrics effectively from the 07-09 Great Recession. Alphabet, no dividend paid, so no comparative data, but they had plus 8.4% recession sales. Remember, that is above the S&P, which sat at negative 12% during that period. We're also going to look at this valuation model for each one. It is, in essence, comparing the forward PE against the valuation. The blue tunnel right now indicating the fair price, and what we've noticed over the last 12 months, it has been towards the lower end, if in the blue tunnel at all. Right now, as it sits outside that, that is an indication of severe undervaluation. But remember, we're not concluding on any of these companies until we look at the valuation process ourselves, which we will do after we run through the metrics for each one of these 7. Now, typically on this channel, we do look at dividend yield theory, which says a company is undervalued when the current yield sits above the 5-year average. Not one we'll comment on for Alphabet today. They are a newly paying dividend company, so this information is a little bit irrelevant. However, the forward PE, a lot more relevant, 19.1, the 5-year average of 22.8, does indicate there another undervaluation signal like we saw just above. We also note in terms of comparing against the sector PE for communications at 19.3, Alphabet isn't too far off, so pretty much you could argue in line with the sector overall. Now, the first metric we're going to focus on today is the free cash flow payout. As always, we do draw your attention to free cash flow. Earnings is susceptible to manipulation by management through accounting, and we want to use below 60% as our blanket rule for each company. That does give us faith management can increase dividends at a double-digit rate, which is what we ultimately want to see as dividend growth investors. Now, over the next 12 months, anticipated 11%, so we wouldn't be surprised if we don't get a very strong increase, especially as it is the first and their free cash flow payout is low from Alphabet. We then move on to the free cash flow per share, where we want consistent increases over the longer term, more than a 5-fold increase from 2014 to 2023, and we can see the expectation over the next 12 months at $7.08 per share is massive growth just over a 12-month period. Then we look at sales growth, where we want double digit ideally, however at a bare minimum 3 to 7%, although we would say 3 to 4 just to keep up in line with inflation, as the US inflation rate over the last 40 years has been at 4%. And remember, if you're not increasing your dividends, your salary, your other income producing assets by a minimum of 4%, you're taking effectively a pay cut and losing your purchasing power. Now, nice to see for Alphabet, double digit every single year bar 2023, but on a trailing 12 month at 14%, does indicate the annual report of 2024 will be very strong above the previous year. And then from a numerical perspective, we can see this growth around fourfold from 2014 to 2023. And on top of that, they've bought back more than 1 billion shares over the last 10 years. Remember, we focus on this because in essence it's returning excess cash to shareholder pockets. Now, we have seen them issue equity, dilute your position from 2014 to 2017, but since then they have been doing share buybacks and it is part of their capital allocation currently, so we do expect this to continue in the shorter term at least. ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. Very strong numbers from Alphabet, double digit every year, nice growth over the last 3 years, 32% on a trailing 12-month basis is very attractive, not just for investors, but also for those who are potentially considering adding to their portfolio. Then we get to the margins, two things we want to note, minimum 12%, which we can see for Alphabet, but also operating efficiency. We don't just want to see revenue increase, we also want to see margins increase over the longer term. Not something we see clearly with this company, but nonetheless, 26% to 32% on a trailing 12 month is still an increase, and no worries whatsoever on the free cash flow, looking very strong on a year-on-year basis. Even 17% is healthy on the trailing 12 month. Then we get to the net debt to EBITDA. Oh, how we wish every company would reflect this. This is the earnings before the interest, tax, depreciation, amortization. Below 3 is what we want to see for the majority of companies. And remember, this correlates to both dividend safety, balance sheet strength, with the numbers, or we should say for Alphabet's sake, the lack of numbers indicating the number of years it would take the company to pay off all of their debt net of cash on hand. Not even one across the board or over the next 12 months, telling us not only that the balance sheet is strong, but for Alphabet, it wouldn't take them one day to pay off all of their debt net of cash on hand. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we're running through 7 stocks, so we won't go through each one's valuation process, but we'll just highlight Alphabet today, the first one, to give you an idea. Now the intrinsic value for this company is calculated based on the DCF, so what we've effectively done is have the free cash flow year on year, average growth at 24%. We've gone here today at 12%, which we have as the medium rate, low, medium, and high. We've then used the discount rate to get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, $215, indicating 31% upside. Now you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alphabet or any others, but for full transparency, we'll just show you, again, just the first stock today, at 10%, $187, upside of 14%, at the 14, for those that are a lot more bullish, 247, indicating 51% upside. Now, as we said, we'll take through the 12% today, and ultimately we use a margin of safety, MOS, for every company that we look at. We execute at a 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that today, a buy up to $194, and then we keep going until it's near the current trading price. And what we can see in today's episode for Alphabet, not at the 25% level just yet, sitting somewhere between 20 to 25%, with Wall Street very bullish over the next year. In fact, we did say nearly a strong buy for them, $210 price target with upside of 28%. Now, it is a Mag 7 stock. Yes, there are some bearish indicators over the next few months with the DOJ probing for this company to essentially divest their Chrome business. However, we still believe it is a strong consideration in the portfolio. Whether or not 20 to 25% MOS is enough for you to consider with Wall Street's 28%, do give us your thoughts below. Buy, hold, or sell. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we highlight severely undervalued stocks that we believe deserve your attention, as well as what's gone in the market over the last few days. So click below, sign up, and you can start reading straight away. You'll also be able to gain access to 40 undervalued dividend stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a newly released spreadsheet where we run through 29 undervalued dividend stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, sign up, and you can start reading straight away. We then move on to ASML, one we have covered extensively on the channel that we still believe incredibly attractive. We have a double buy rating from Seeking Alpha and Wall Street, a hold from Quant, this one pretty much trading right there towards its 52-week low. The forward yield now sits at 1%, the forward P at 33.24, and whilst it is down 1.8% over the last 12 months, it has massively outperformed the S&P over the last 10 years, up 519%. Bear in mind, it would be up higher if you do reinvest your dividends, and we can see it is quite some way away from its all-time high at $1,110. They also anticipate double-digit growth quarter on quarter to the earnings per share, with some very large beats over the last year, 100% track record, and with a large increase expected to the EPS over the next full-year accounts. That forward P is expected to come down to 27.26. Now we have our first very safe dividend score at 82. We'll cover these two models that show undervaluation, but as we have historically said, disappointed with their increase at 4.8% in July this year. Yes, it is above the 4% inflation we target, but historically they have increased it at a much rapid rate. Now this is just to highlight very safe ultimately means a dividend cut is highly unlikely, and also we need to let you know in the last recession they actually cut the dividend, they didn't increase it, they didn't maintain it. They had below average growth quite significantly, negative 56%, but they had pretty much an inline recession return, negative 55, S&P itself the same at negative 55. Like we said, disappointed this July given that over both the last 5 and the last 10 years they have been increasing those dividends at the double-digit rate, and we also note they have been increasing those dividends for the last 14 years on a consecutive basis. So in terms of the first model here on the forward P, we can see not for a long time this company is now severely undervalued, well below the lower end of the expected fair price. And when we also look at dividend yield theory and essentially the forward P, both signs of severe undervaluation. The yield is above the 5-year, and the forward P, as we can see, sits well enough below the 34.1 rolling 5-year average. We do, however, note it does trade above the information technology at 25.3, so if you are buying this in comparison to the sector, you are paying a premium. Whether or not you believe it deserves one, and whether or not you believe it deserves a larger margin of safety, something we will get to as well. Free cash flow, now we want below 50% for semiconductors, so no surprises in 2023, the 74% led to that very mediocre increase of 4.8%, but great news, over the next 12 months anticipated to come down to 13%, so we would be surprised if we don't get a much more attractive increase. Free cash flow, bear in mind, semiconductor industry, very volatile, so we do get some of that coming through the numbers. 153 to 825, very strong increase, but we do also notice it has been coming down over the last 2 years. Positive to take, expected to near enough triple over the next 12 months to $23.10 per share. Then we move on to the sales growth, where we actually see double-digit increase for the vast majority of the period, although we do notice on the trailing 12 month a small drop is shown at negative 2%. But when we do zoom out, their top line has been increasing at a very attractive rate, just under $6 billion reported 10 years ago. In the more recent annual accounts, just under $28 billion. What they've also done is in fact buy back nearly 10% of shares from 2014 to the latest quarter, which is always very attractive to note. Pretty much, as we say, a bonus on top of some very nice historical increases to the dividend. And the ROIC above 12% for the industry, looking very strong historically as well as the last 3 years. 38% again, still absolutely phenomenal on the trailing 12-month basis. Operating margin, very marginal signs of operating efficiency, 26% 2014, 31 on a trailing 12-month, and free cash flow margin, whilst very inconsistent, nonetheless 12%, 11%, we have no complaints whatsoever. We then move on to that final and very important metric, but it looks great, back-to-back zeros across the board, Alphabet, now ASML, very strong balance sheet. As we said, and as a reminder, it wouldn't take this company one day to pay off all of their debt net of cash on hand. Now our intrinsic value at $1,128 is higher than Wall Street. Theirs is $920, although that is what they see the price in a year's time. They believe 39% upside. So right now we do see a lot of margin of safety with ASML at 10%, a buy at 1015. And as we keep going into today's episode, what in fact we see is this company up to around $677 is giving you a 40% MOS. Now, some people will believe that with the bearish indicators that we have covered in some in-depth dives of this company, that maybe 40% does seem appropriate. Some people may think, you know what, they need a lot more. So just a reminder, at 45%, a buy at 620, at 50%, around 564. But as we said, today's episode, 40% margin of safety, 39% upside from Wall Street. Give us your thoughts below. Buy, hold, or sell. We then move on to Zoetis with a double buy rating, a hold from quant. This one trades pretty much bang in the midpoint of the 52-week range. Similar to ASML, a yield of 1%, a forward P just over 30. And over the last year, pretty much flat. Over the last 10 years, has massively outperformed the S&P, although we can see it hasn't in fact gone above the all-time highs of around 3 years ago at $245. Always great to see green when we look at the expectations moving forwards, so they are expecting growth quarter on quarter. However, when we do look at the prior quarters, we do notice one miss, although good to see that was the one furthest away. 75% track record with nice growth expected in December 2025, lowering the forward P to 27.56. In terms of dividend safety, well, 74 safe, double severe undervaluation signal, and very nice growth of 15% in December 2023, reminding us that Zoetis, we are expecting another increase over the next few weeks. In terms of key metrics, well, plus 30% sales, very, very strong, well above the S&P's negative 12, and also another company with very, very attractive dividend increases, 24, 23% over the last 5 and 10 years respectively, and they've been increasing those dividends for the last 10 years on a consecutive basis. Now, in terms of the valuation, again, based on the forward PE, right now we get that severe undervaluation signal lower than even the bottom end of the expected fair price. And when we take a look at both dividend yield theory and the forward PE, again, both signs reinforcing the fact that this company does look severely undervalued, although do understand Zoetis does trade at a significant premium to the overall healthcare sector. Now, when we've done our deeper dives, as we say, we do believe this company does deserve to trade at a premium. Question is always, how much of a premium should we be willing to pay? Free cash flow margin below 60%, that is what we get every single year, 32 over the next 12 months. So again, no surprises. Sometimes link things with other things. Understand when companies have very low free cash flow payouts, they are able to increase those dividends at a very, very attractive rate. Free cash flow per share has also been increasing over long term, maybe not as consistently as you want to see, but very, very good to see massive growth anticipated over the next 12 months. And no real complaints on the sales growth every single year at a bare minimum 3 to 7%, bar 2015, which was 9 years ago, and nice to see 9% on the trailing 12 month. From a numerical basis as well, nearly doubled their top line over the last 10 years. And when we get to essentially the shares outstanding, very similar to ASML, they've bought back around 10% of their shares over the last 10 years. ROIC, absolutely no complaints, looking very, very strong, 27% on a trailing 12 month. And operating margin, maybe one of the clearest signs we have seen today, not just above the minimum 12%, but we also get those operating efficiencies, something that you really do need to try and find to therefore understand companies that are of high quality can meet that criteria. Free cash flow margin as well, looking very strong, 25% on a trailing 12-month basis, looking very good essentially for 2024. And the net debt to EBITDA, now we don't get zero across the board, but lowering from the all-time highs of 2.57 in 2015, 1.38 on a trailing 12-month, 1.18 over the next 12 months, giving us signs here that their balance sheet does look to be strong and healthy. Now our intrinsic value, $226, unlike ASML, not far off Wall Street's 223, where they see 27% over the next year. And then when we run it through the MOS today, what in fact we can see is that Zoetis, which we do believe to be a fairly strong company, not quite at the 25% level yet, but you're getting somewhere between 20 to 25% with Wall Street bullish, as we said, 27% over the next year. We then move on to Lam Research, another semiconductor looking very good, very attractive, double buy rating, hold from quant, trading very near to its 52-week low, a forward yield of 1.26%, a forward PE of 20.5 below the S&P, very minimal movement over the last year. Over the last 10 years, massive outperformance of the S&P, up 769%. We also love the fact not just over the next 4 quarters, double-digit growth EPS expected, but also nice outperformance on a quarter-by-quarter basis, 100% track record. In turn, if they hit their EPS for their next full year accounts, the forward P will come down to 17.3. They also have a safe dividend score of 66 and a very attractive increase of 15% to the dividend in August this year. Now, key metrics, they had below average growth and they also trailed the S&P with their negative 64%. We always love to see double-digit increase. It is something we really like as dividend investors. 46% on a year-on-year basis over the last 10 years, absolutely phenomenal, with 10 years of consecutively increasing the dividend. Now, in terms of looking at the valuation model today, over the last year, we can see it now for the first time in quite some time, right at the bottom end of that expected fair price. And when we take a look at both dividend yield theory and the forward P, you could argue they aren't too far off. So either slight undervaluation or reasonable valuation noted, but we do see this one trading at a discount to the overall sector P at 25.3. Now, in terms of the free cash flow payout, again, not surprised that it is below 50% given the very strong increases over the last 10 years, 27% expected over the next 12 months. We get the increase to the free cash flow over longer term, remember, very important to note, and marginal growth anticipated over the next 12 months. And whilst we do see the cyclicality in the numbers for Lam Research, nonetheless, over the longer term, very attractive. 2 out of the last 10 years negative. Unfortunately, though, the more recent year, negative 14%. When we do zoom out, though, we see pretty much 3 times growth from 2015 to 2024. And whilst inconsistent, they have been buying back a lot of shares from 2015's 1.77 billion to the latest quarter's 1.31. ROIC well above the minimum 12%, 34% just on a trailing 12-month basis. And on the operating side, we do get that operating efficiency above 16%, 17 in 2015, 29 in 2024, and free cash flow margin, absolutely no complaints, very high, 31% on a trailing 12-month basis. We nearly get 3 for 3 in today's episode at 0 across the board, but nice to see in 2024 0, same on the trailing 12 month and expected over the next 12 months. Balance sheet very, very strong. Now our intrinsic value, $98, pretty much in line with Wall Street at 98, where they see upside of 34% over the next year. And when we do run it through the MOS calculation, in today's episode, you're pretty much getting a 25% MOS if you're buying the company today with some very, very nice upside. As always, though, give us your thoughts in the comments below. Maybe you prefer ASML, maybe you prefer other semiconductors, and we will get to one more later on today. We then move on to Fomento Economico Mexicano, FMX. Now we get the Wall Street buy rating, we get a hold from Quant. Now this one is trading at its 52-week low with a forward yield of 4.75%, very high, or in fact the highest so far today. In terms of the forward P, 17.5. Over the last 12 months, around 30% down. Over the last 10 years, it is also down, so not looking great on a historical basis, but we can see in terms of the all-time high, it was hit this year at $141. When we take a look at the next 4 quarters, 3 of them, they are expecting to be a decrease, with the more recent quarter coming in at an anticipated 33% uplift to the year-on-year EPS. When we do look back over the last 4 quarters, though, we can in fact see 75% track record. Nice to note, very strong beats over the last 3 quarters. And December 2025 EPS is anticipated to grow, forward P thereby coming down to 17.04. Now, we don't have the dividend safety score, but we can see a very rapid increase to the dividend in the last full year at 20%. And in terms of growth, well, they aren't shy in terms of very large increases, 9% over the last 5 years, 17% over the last 20 on a year-on-year basis. But in terms of looking at the financials, when we do get to the free cash flow payout, this is something we have a little bit of a concern about. In terms of 2023, triple digit, remember this highlights to us management paid out more in dividends than they generated in free cash flow. The only positive thing we will take from here is that over the next 12 months, it is anticipated to come down sharply to 14%. We then get to the free cash flows, which are very inconsistent over the longer period, but nice to report over the next 12 months, it is expected to jump to $12.80 per share. We then move on to sales growth, double digit for the majority of the last 10 years, 18 over the last 2, 14 on a trailing 12 month. These are metrics we definitely want to note. And in terms of their total sales, well, we can see some very strong growth, nearly 3 times over the last 10 years, with shares outstanding very flat, not even any share buybacks or any issuance of shares over the last 10. In terms of ROIC, remember we want at least 10% at a bare minimum to give us faith management are able to effectively allocate their capital. Something we see near enough does straddle around that 10% point, 9% in the more recent year. And then we get to margins, again something that we do want to keep an eye on. At a bare minimum, we want 12%. Not something they've been able to hit, but the inconsistency is definitely something that we would say to add an extra element of that margin of safety. Free cash flow margin, we want around 5%. When we do zoom out, it is something they can hit on a year-on-year basis. Just a bit disappointed about the drop into 2023. And then we get to the net debt to EBITDA, has come down to 0.47, is expected to go up over the next 12 months, but still well below that maximum 3 that we want to see. Therefore, balance sheet does look good, dividend does look to be safe. So our intrinsic value today at $123 is actually lower than Wall Street. Theirs is $128. They see upside of 47% over the next year, very, very high. And in terms of our MOS, well, we also see quite a nice margin of safety in today's episode, pretty much at the $86 mark, 30% with upside of 47%. Definitely one we would like your thoughts about. Maybe you would like a deeper dive, and we can cover this in a lot more detail. We then move on to another semiconductor, KLA Corporation, with a double buy rating and a hold from quant. This one is trading towards its 52-week lows. In fact, it was around its 52-week low that we covered this not too long ago, where it did look like a striking buy. In terms of the yield, 1.06%, forward PE around 20.8, and over the last year, underperformed the S&P, up 15%, but over the last 10 years, massive outperformance, up 821. Now, as always, we love to see green right across the board. Management every quarter anticipating upside and massively outperformed over the last 4. Ultimately, they do expect this to continue over the next full year, lowering the forward PE to 19.4. In terms of dividend safety, 71 score, and we will run through these methods, but we love the fact that their more recent increase 2 months ago was at the 17% double-digit rate. And when we do look at the last recession, unfortunately, they didn't increase the dividend, but they also didn't cut it. They maintained it. They had below average growth, but they also trailed the S&P negative 70%. As we have covered the most of the stocks today, very nice dividend growth. KLA Corporation is no different at 12% year on year over the last 10, with 14 years of consecutively increasing the dividend. Now, in terms of the valuation, firstly on the forward P, we actually notice right now it is in the mid to upper end of the expected fair price. And when we take a look at dividend yield theory and the forward P, both signs of around reasonable valuation based on the 5-year average, although we do note it does trade at a fairly large discount to the information technology at 25.7. In terms of free cash flow payout, no surprises here given the fact it has been double digit every single year, 23% as well over the next 12 months. Again, we do expect that to continue. Free cash flow actually looking very strong for a cyclical industry in terms of the consistency, massive movement from 2015 to 2024, and again another massive movement is anticipated to the upside over the next 12 months. In terms of sales growth, no real issues here. We do understand 2 of the last 10 years, including 2024, have been negative, but when we do zoom out, we can see some very large growth, more than triple over the last 10, whilst also doing some share buybacks, again, fairly inconsistent, so not one we would consider management are prioritizing in terms of the capital allocation. ROIC very, very strong, as pretty much the majority of good companies in the semiconductor industry are, 35% on the trailing 12-month. And in terms of the operating margin, in fact, both margins very, very good, well above the minimums. And whilst there are no efficiencies to be seen directly, we can still see around the high 30s is a very good metric for any company, let alone a semiconductor one. Also, balance sheet looking very strong, 0.47 net debt to EBITDA over the last 12 months, and anticipated to go even lower over the next 12. Now our valuation, $840, very nice MOS in today's episode. When we keep going, not at the 30% level just yet, but we believe this company right now is sitting somewhere between 20 to 25%, and that is very strong for a company that we do believe is of high quality. Again, we have covered this not even that long ago where it was even lower than right now, and Wall Street again sensing that undervaluation, $810 price target with upside of 27% over the next 12 months. We then move on to Danaher Corporation with a double buy rating and a hold from quant. This one is trading towards the lower end of the 52-week range. a forward yield of 0.46%, a forward PE of 31.34, and over the last year up only 6%, but over the last 10 years outperforming the S&P up 180%. Now, as we always say, we love to see green, and that is again a continuation from the majority of companies today, looking very good in terms of forecasting as well as their historical accuracy. EPS anticipated to grow December 2025, therefore expected forward P just above 28. Dividend looks to be safe, 73 score. Nice to see the continuation of double-digit increases to the dividend, 13% in February for this company. And when we take a look at the last recession, they increased the dividend. They had below average growth, but they did outperform with their negative 42% return. Again, nearly every company we have reviewed today has been increasing those dividends at a historical double-digit rate, and this company has 10 years of consecutive increases whilst paying for a dividend 24 years without a reduction. In terms of the forward P valuation, over the last 12 months, it has been decreasing. In fact, the majority of the time, it's been overvalued. Right now, it's sitting at the lower end of the expected fair price. And when we take a look at both dividend yield as well as the forward P, they give us signs here of reasonable valuation in comparison to the 5-year average. But understand, this company does trade at quite a significant premium to the healthcare sector overall. Free cash flow payout, no surprise again, not only below 60%, but in fact below 20% every single year, 14% anticipated over the next 12 months. Free cash flow, now it does look very inconsistent, so bear that in mind, nonetheless has increased when we do zoom out over the last 10 years. And when we look at the sales growth, nearly double digit every single year, but we do have to point out 2023, one of 3 years of negative growth, trailing 12 month at 13%, giving us a sign that 2024 accounts will be very strong. And when we get to it from a numerical perspective, pretty much doubled their top line over the last 10 years, whilst also marginally diluting your position as a shareholder over the same period. Then we get to the ROIC, which has been straddling around the 10% year on year, 7 in 2023 and on a trailing 12-month basis. And we do see a little bit more inconsistency on the operating side, but always great to see, even with inconsistency, well above the minimum 12%, and no complaints on the free cash flow, looking very strong, very healthy, and very consistent. Net debt to EBITDA below 3 is what we want. That is what we get. 1.82 in 2023. Marginal increase anticipated over the next 12 months to 2.03. So again, just something to consider, but no worries at the moment based on this information in terms of the balance sheet. Now our intrinsic value at $281, a little bit lower than Wall Street, 291, where they see upside of 23% over the next year. And when we look at the margin of safety, at the 10% level, a buy at $252, at 15%, pretty much where we see this company right now. If you want 20%, around 224. If you want 25, around 210. So today's episode for DHR, we see 15% MOS with Wall Street indicating 23% upside over the next year. As always, give us your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below, and also come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.